good morning or good afternoon, depending on what side of the country you're joining us from. Thank you for joining us, our Investments 101 webinar here. Really excited. Here we are in wonderful sunny Detroit in April, and I'm going to just put the precursor out there. If you hear a lot of noise in the background, we're expecting a torrential downpour during this webinar today, which makes things very, very exciting. On the next slide here, I'm Charlie McQueen, President of McQueen Financial Advisors. I'm really excited today. We have our three areas of expertise. We have our asset liability management team, our valuations and transaction advisory team, and then our investment advisory team. And so today I'm joined by two of our incredible investment advisors. First one, Alicia Bradley here on the next slide. Really thrilled to have Alicia here. She's one of our excellent investment advisors, works with a number of clients and manages wonderful bond portfolios, oversees traders and different things in the company. So we're really excited to have Alicia here to share her expertise with us. Along with Alicia, we have on the next slide, Zach Whaley. Zach is Alicia's co-presenter, or Alicia Zach's co-presenter, Zach's Alicia's co-presenter, whichever way we're going to go with that one today. But really excited to have Zach here. Zach works with our investment team, also a seasoned advisor, spends a lot of time in our alternative portfolios area also. And so really excited to have Zach here with his expertise and Alicia here with her expertise. Thank you both for joining me today.
Thank you, Charlie. And to be clear, I am second billing, so we did this correctly.
Yeah, well, you got to do it in the right order.
That's right. It's great to be here. I'm excited.
Cool. Well, thank you both for taking the time for this. As we go to the next slide, just a couple housekeeping things. If you have a question, you can hover around your screen. You'll see the little Q&A bar. Click on that or Q&A button, hop it in there. I will be interrupting these two wonderful speakers if it's something very timely and fits in, or I'll ask them the questions at the end. So please, participation is always encouraged. Great questions, fun questions, silly questions. Our video, as usual, our webinar is being recorded. It'll be on our website and our YouTube channel. Please feel free to reach out to see any of our past videos or this one once we're done. This is definitely an interesting time, and I'm really excited to hear some comments about investments. Lots of news about investments and banking and credit unions and Silicon Valley Bank and all sorts of things out there. And I'm excited to hear your insights and information. So again, thank you both for your dedication, and I'll hand it off to you guys for the next slide.
Very good. Really appreciate it, Charlie. Thank you. And Miss Bradley, ready to get into this?
I'm excited.
This is
very excited.
It's going to be a good thing. And, Charlie mentioned silly questions. So let's have a prize. Whoever has the silliest question at the end of this gets something. We'll figure it out.
Okay.
We'll get a Charlie bobblehead. How's that sound?
I like it.
Okay, great. All right. So let's
talk about. For the record, I do have one, and I might auction it off. So just throw it out there.
That's awesome. We need to see a picture of that at the end of this, Charlie. All right, so let's get into it. We are going to do a very brief economic update. Our goal is to do it less than 5 minutes, and Alicia's going to throw a water bottle at me if we go longer than that. And then we're going to talk a little bit about SVB. That was the biggest news going back 3 weeks ago. It feels like it was yesterday and 3 years ago at the same time. Pretty wild. Yeah. But there are definitely some lessons to be learned with SVB. And then we're going to get into portfolio strategy, a little bit about different asset classes, get into my favorite topic is policy. It's not true.
Read the sarcasm there.
Exactly. Yeah. But it's Bradley. She's here. She's the policy expert. And we're going to get into trading and documentation. Alicia, what's the goal? What's the takeaway that we're looking for on this talk today?
Just a basic overview of what the investment portfolio entails from a very broad level standpoint. Everything you need to know to go into it without getting into any of the minutia or intricacies.
Yeah, very good. So if you're joining and you're thinking, I don't know anything about investments, you're in the right spot. But if you're thinking, I know a bit, I think you're still going to get something out of this. It'll be a good conversation.
Yeah.
All right. So the first on the very brief economic update is one of our favorite graphs, which is the U.S. Treasury curve. So Bradley, what are we looking at here?
We've got this lovely red line at the top, slightly inverted. We've seen a decent amount of movement over the last month or so, given the failure of SVB, Signature Bank, Credit Suisse, whatnot. The curve has shifted downwards. We've seen quite a bit of movement, especially along the 2-year, roughly 120 to 130 basis points, give or take the day, intraday, what the economic news is for the day. A lot of volatility in the marketplace. But what it means is the potential for compression to margin and spread. Loan rates are up, which we love, but borrowing costs have started to rise quickly over the last several months. So that's something for us to keep an eye on. But more importantly, if there is liquidity to put to work in the investment portfolio, where is the best point along the curve right now to put some of that to work? And what do those yields potentially look like?
And that may foretell a little bit about what we're going to talk about.
Yeah.
And I'll give you a spoiler. It's not what you might think. So let's look a little bit. So this is one of my favorite charts here too. And this is a look back essentially of what has happened with the Fed rate. This is the interest rate that the Fed controls. It's what you earn on your overnight cash or thereabout, depending on where you keep your cash. And that's the red line. And we also look at the blue line, which is the 2-year Treasury. I call it the dance partner of the Fed rate because you can see historically they are always pretty close to each other as we go through time. And then the dotted line is the 10-year Treasury. And what I wanted to point out on this particular chart is we can see that what's going on now, which is the far right of the chart, all of these lines are converging, right? The 2-year and the 10-year and the Fed rate are all jumbled up. And when we look historically, when that's happened, the last time it happened was 2018, 2019. And what did that foretell? It foretold interest rates lower, and which is crazy because nobody was talking about anything too weird in 2019, and we all know what happened in 2020. And you go back to 2008, same thing. We had a jumbled mess, an inversion of the yield curve, which Alicia just pointed out, and then a year or two later, boom, the Fed rate dropped to the floor and stayed there for a long time.
Yep.
So-
Don't move it just yet.
Yeah,
The one
sure.
thing to point out, Mr. Willie talked about how we saw those decreases in terms of yields in the 2-year. If you look at the data between, or the correlation between the Fed funds rate and the 2-year Treasury, in all of those instances before we saw rate decreases, we saw the 2-year Treasury fall below the Fed funds rate. That's the market's indication of, are we at our max? Whether we are or not, time will tell. We've seen a lot of movement in rates over the last month or so. But the one thing to note is that every time before the Fed decreases, that 2-year Treasury starts to trend below that Fed funds rate is a potential indication that the Fed may be getting to move rates lower. I
And
say
guess
potential.
where we are right now, right there.
Is that the next slide?
Yeah, well, yeah, let's look at what the predictions are. So this is the crystal ball of where the Fed rate's going to be. And this is always right 100% of the time, right?
Every single day.
Every single time. What are we looking at here?
So the graph here, most of you already know, is the FOMC future meeting dates and what the implied rate is going to be. That implied rate comes from various market surveys. So as of right now, the market is still anticipating another 25 basis point increase at the May 2nd meeting. Even though the 2-year Treasury is well below what the Fed funds rate is right now. The Fed has stated that they're going to continue to increase rates. They have a dual mandate, increased unemployment and decreased inflation, and they're hoping that by raising rates, they can achieve both of those. So as of right now, the market is stating another 25 basis point increase in May, and then we can start to see those decreases throughout the rest of this year. There's one there in July, one in November, and one in December. None of these are set in stone. They change intraday, they change weekly as various economic data points come out and the market sentiment changes.
This looked totally different on March 9th, didn't it?
Absolutely.
Right.
We had 3 rate increases, I believe, in there.
I believe so.
I think it was
yeah.
3, up to 575.
Yeah, it was the shape of this line was completely different. It was pointing up. There were still a lot of people thinking we were near the highs of interest rates because of what the curves were doing, what we've already talked about. But now we can see it's actually predicting that we go down, which is just fascinating, and it definitely makes sense.
Yep.
So the last economic slide that we're going to look at is the stock market. And we're not going to talk much about the stock market today. It's not an asset class that we typically would consider a 101 investment, but it's important because it really shows what the overall sentiment of the economy is. There's this phenomenon called the wealth effect. If I go on my little application, I'm looking at my IRA and my investments and it's green, I'm feeling happy, right? I shouldn't be tying my emotions to that, but I might go out and buy more things. And really what we've seen going back to the end of last year is the stock market was on a really big retracement, but still, if you zoom out, we are absolutely still in an uptrend. And it's fun to argue back and forth about where we think the market's going to go. Time will tell. But right now, the market's really trying to figure that out. It's been going sideways, and we'll really see where we move from here.
Yep.
So let's get right into the topic at hand, Miss Alicia. We're going to talk about everybody's favorite bank failure over the last month.
SVB.
Right.
For those of you who are unaware or have lived under a rock, SVB, Silicon Valley Bank, had a run on their deposits. They had, one depositor pulled, that depositor called everybody else and said, pull your deposits, and all their deposits disappeared. There's a lot of reasons that they disappeared. I don't want to skip around the slide too much. One of the things we don't know is what their investment letter looked like. So we don't know how much cash they had coming due right now, but what we do know is that they had a significant amount of long duration investments. And then when they went to sell those investments, as with everybody's investment portfolio right now, those investments were underwater. Those investments being underwater made them take a large loss. They had to run it through their income statement, and it was significantly larger than anticipated. Combining that with the run on deposits, they simply didn't have any money and they couldn't borrow enough to cover it all.
It was an interesting time going back to when rates fell in 2020. And what we saw was rates were so low, cash was paying nothing, right? Remember when cash was at 0%?
Zero, nothing.
Is at 0%. And SVB put money to work. That wasn't the problem. They should put money to work. The problem is they said, we're not going to build a diversified structured ladder, which we'll get into more later, where you have some maturity dates coming due, a year and 2 year, 3 year, et cetera. They said, we're going to go mostly long. It seems like that's what the data that we have tells us. And not only that, but they hid their risk by going into a accounting treatment called held to maturity.
Yes.
And tell us about held to maturity a little bit more, Alicia. What does that do? What does that hide exactly?
So a couple different ways to code your investments from an accounting perspective: HTM, or held to maturity, AFS, or available for sale. The majority of portfolios hold their investments as available for sale. It means that if you get into a liquidity crunch, like SVB was, you can sell your investments. It also means that the unrealized loss amount on those investments, again, it is unrealized, doesn't need to run through your income statement. It flows through your equity or your capital number. So you have the potential to see a decrease in your capital position or your net worth based on that unrealized loss amount. The one thing SVB did was they coded those investments as HTM. So when you code them as HTM, they don't impact your equity or your capital number. So the true unrealized loss amount was unknown to them. It had to be somewhere hidden in some financial statements. Somebody had to know about it, an internal auditor. I hope somebody in the finance department knew about it. But because of that, that number was unknown, which caused them to have this significantly larger loss than anticipated because it wasn't being reflected anywhere in any sort of financial statements. Which then leads us to, if you're not recording that anywhere, how good is your balance sheet management? How good is your accounting department doing, or your advisory team doing, in making sure that you're aware of what those potential pitfalls are when you hold investments as HTM versus AFS?
Right. So the bottom line is, the strategy wasn't really there. They leaned into one thing.
Yep.
They were overly concentrated in their investments. And by the way, they were overly concentrated everywhere else. Their loans, their amount of uninsured deposits, the type
Absolutely.
of depositors. So if you're on the line right now and you're wondering, oh man, is this risk? Do we have the same risk? No, you probably don't. But it's important to look at our investment strategy to make sure that we're eyes wide open in conjunction with our balance sheet, instead of tunnel visioned on one particular goal. They were chasing yield and they're really doing it the wrong way.
Yep.
So let's keep it moving on what to do. And that leads us to portfolio strategy.
Yep.
And when we think about portfolio strategy, one of the most important things that I hear, or questions that I hear, is like, wait a second, I'm a financial institution. I'm here to do loans, right? That's
Right.
that's what I'm here.
That's what you do. Give back to your community.
Yeah. But if my goal is to do loans, then why do I even need a portfolio? What do you think about that, Miss Alicia?
Your portfolio provides you with several things. So during COVID, to coin a term I heard from a client, COVID cash. Nobody was making loans because the consumer wasn't sure about what was going to happen. They couldn't go anywhere to make the loan. They couldn't buy a house. They couldn't buy a car. They couldn't remodel their house. So there was no lending to be had. So there was all of this excess cash, and that excess cash can then get invested into your investment portfolio. And it provides you, again, I'm going to skip around the slide here a little bit, but with earnings. So your overnight cash, as Zach mentioned, for a long time, the rates were at zero. We could earn more by putting our overnight cash in an investment, and it provides us with cash flow. So that cash flow can then be used to meet future lending needs or potential cyclical demand in our deposits.
Yeah, absolutely. So when we have, we want to lend, to the extent that makes sense, right? We're
Absolutely.
appropriate credit risk. We're here to help our community. That's the whole goal. But when we have an excess amount of cash, it's in normal times, you're making far less earnings on that cash than you are on an investment. So it's a way to increase earnings. But then let's talk a little bit about liquidity, because I think this is, as we'll see in future slides, one of the most important things. What does liquidity even mean? And how can liquidity help to complement a lending strategy?
We want to make sure that the investments in the investment portfolio are liquid. All of the different asset classes that come from federal regulation are fairly liquid, some easier to get out of than others. Some have a larger secondary market than others, but everything is very liquid from a termination standpoint. So if you have to go out there and sell it, there should be no shortage of bids on any of the bonds we hold in the portfolio. So in times where you don't have a significant amount of deposits coming in and lending is going really strong, it may make more sense to sell an investment out of your investment portfolio than it does to borrow, depending on what the potential gain or loss on that investment is when compared to the interest expense that would be incurred if you had to take out a term borrowing or run a deposit special for that matter as well.
Right on. And that liquidity supports the lending.
Exactly.
So when we think about going into some principles here, I remember this. I promise I'm not kissing up to my boss who's on this call. But I remember being in a meeting early on at McQueen, and Charlie said, you know what, here's the order that which we focus on. We focus, number one, on safety and security. Number two, we focus on liquidity. And then finally, we focus on yield. And it's in that order. And it's really interesting because from a personal finance standpoint, man, we just want to make the biggest earnings that we can, right? We
Yep.
want our money to be safe, but everybody always talks about yield. So my question to you, Alicia, is why are these ordered very intentionally in this order? Why isn't yield on top?
Because we never want to chase yield. We always want to make sure that the investments we're putting in the investment portfolio are safe and secure. Some investments, I don't want to say are safer than others. Some are more boring than others, i.e. a risk-free treasury note, 0% risk rating versus a corporate bond, 100% risk weighting. So both safe, but we want to make sure we know exactly what we're purchasing from a safety perspective, because some of those bonds do have risks. Just like ALM, the goal is not to get rid of the risk completely, but to manage the risk that we're putting in the portfolio. A couple of those risks include principal. So we want to make sure we're not overly concentrated in any specific asset class or in any specific investment within the investment portfolio, as well as premium risk. We want to pay attention to the dollar amount that we're paying for each of the individual bond and knowing how that premium is going to be amortized over time. So safety is always our first priority when looking for any investment for the investment portfolio to make sure it fits within the client's strategy.
Excellent. And that's super important. And, it's the whole eggs and baskets conversation, right?
Yep.
We don't want to be overly concentrated. And let's look at these pictures, these beautiful histograms here, I think is the technical term, if I put my nerd hat on.
Graphs.
So graphs, there we go. We'll go with graphs. So so this is a ladder, right, Alicia?
Yeah, that's a standard ladder in the top picture. It's what the majority of our portfolios look like. We have the very first year, which is the smallest set of two bars, the green bar and the beige bar. Your first year tends to be your smallest year because some of it's already paid off, but you can see how the cash flow increases slightly and then starts to come down. And then on the tail end, most likely tail end cash flow coming from amortizing securities. So it gives a good structure to the portfolio. So you know how much is coming due in which year. In the portfolio report, it's then broken down a little bit more by quarter, by month, by year. So you can see what comes due in any given year. The bottom graph there then is a barbell strategy, which we don't see quite as often. Not beneficial to every single client based on what their strategy and their portfolio needs are, structured a little differently with the majority of the cash flow coming due now, less cash flow coming due in several years, and then an increase in cash flow coming due longer term. Tends to be based on what lending strategies are, potential borrowing paybacks that may be due in several years, and a couple of other things. But each graph is going to be strategy dependent.
Perfectly said. That's a huge takeaway because it's easy to say, well, this one is the one I want.
Right.
Well, let's talk about it is really the next step, because do you have a big cash need in year 3? Each of these are years again. So if you have investments that are coming due in the 3rd year, maybe that's important for you. And that's
Right.
going to make your ladder look a little bit wonky, right? It's going to have a
Yeah.
spike, a step. You're going to trip over that step on the ladder. There's steps on ladders. Think I'm thinking steps, but you get what I'm saying. The rung on the ladder.
Yeah.
All right. So now let's get into the basics. The basics are essentially, we're talking about bonds, right? That's what we're primarily talking about. So, Alicia, let's define the bond. I know you got your Webster's dictionary
I do.
over there.
My Webster's dictionary definition of a bond is a fixed income instrument that represents a loan made by an investor to a borrower, or more simply put, an IOU, or Zach and I like to call it, Zach buys me a sandwich on Monday, and on Tuesday, I have to buy him a sandwich and a cup of coffee because I have to pay him interest.
That's quick, fast interest. Annualized, that's a lot of Starbucks.
It's a lot of Starbucks.
I love it. So it's an IOU is
Yeah.
basically what it is, right?
Yep.
You buy something, you're going to get it back in a certain maturity date, a certain amount of years.
Yeah.
During that time frame, you're going to get paid yield, and then at the end, you're going to get your money back, and that's really what we're talking about.
Or in Zach's case, a cup of coffee.
A cup of coffee. And I'll do a half calf, por favor. All right, asset class diversification. Let's talk about this. So diversification is a commonly used term when we're thinking about any type of investment strategy. So when we're talking about for an institution, why is it important? So number one is yield. How does a diversified portfolio help with yield, but still keep into context those other important things of safety and liquidity?
So when it comes to yield, we all know that if you go out and buy, maybe stock A is going to have a dividend of $3 per share, and stock B is going to have a dividend yield of $8 per share. But maybe that other stock is a much higher dollar price, so you can't necessarily buy as much of it. So you're going to diversify your portfolio to get a better return. From an asset class perspective, we want to make sure that we're looking across the whole spectrum of what we can buy, because the yield in asset classes changes from time to time. For anybody who has cash to put to work right now, you'll know that CDs are where there is yield. They haven't moved the way the treasury curve has come down. The value has stayed there. There's value in other asset classes, but the most value right now we're seeing is in CDs, and not a lot of value in mortgage-backed securities, for example. Other times, mortgage-backed securities have a larger value than any other asset class. Obviously, from a cash flow standpoint, they're a little bit different, so that gets into that maturity and average life piece of the diversification. But different asset classes have different values at different points in time, depending on what's going on in the market and where that yield curve is. So being able to take advantage of different asset classes based on how the yield curve is shaped and its point in time allows us to pick up the most yield within the investment portfolio while still picking up safe investments and maximizing our earnings.
I love it. And you use CDs as an example. It's my favorite example because so oftentimes when we're working with institutions, let's say before they were just buying investments without an advisor, maybe they've got a portfolio of completely CDs.
Right.
It's all CDs. It's 1 year, 2 year CDs, sometimes 3 year. Nothing necessarily wrong with that, but it's very limited. And so we look back in 2020, if that was your strategy, if that was your capability, maybe your policy only allowed for it, or maybe it's just what you were comfortable with. Well, you know what? You were buying really bad yields for about a year.
Yep.
And the reason is because nobody needed the cash. So if you're out there buying CDs, you're basically saying, hey, financial institution, let me give you money. And they're saying, thank you very much. We just got all these stimulus checks.
COVID cash.
We don't need it. But now it's amazing. It's the best thing ever.
Yeah.
You can still, even by the way, in this time, you can do a lot better than CDs with other instruments that we'll look at in a second here. So let's get right into it. What are the different types of bonds that we often see in these portfolios?
I have the boring slide. I have the very vanilla. There's a little bit of non-vanilla in here, but these are about as vanilla as they come. So your treasury bills or your treasury notes, they are the basis for all investments. It's what most everything is priced to. They're 100% or 0% risk weighted. They are an explicit guarantee of the US government, guaranteed to get your money back, about as vanilla as they come. We've got agency bonds, which are backed by GSEs or government-sponsored entities. Bullet structure, again, extremely plain vanilla, set coupon, set maturity date. Those also come in a couple of different types of agency bonds. There's callables, which have a call structure to them, meaning that the issuer has the option to call it back at a certain point in time. And then also step bonds, which are going to step from one coupon to the next, meaning the rate will change. They often tend to be callable at that step date as well. So a little harder to model, yield not always known right up front. And then a little more intricate, we have MBS and CMOs, which are going to be backed by residential mortgage pools. We look at the government-backed options, so anything from Fannie Mae, Freddie Mac, or Ginnie Mae. There are some private label MBS and CMOs out there. Think back to 2008, 2009 to your Countrywide days. Those are those types of bonds. Not something that we look at actively. We do have a couple of remaining ones in portfolios that are quite old. So not something we're super active in, but definitely something that's allowable. And then CMBS, which is simply commercial mortgage-backed securities. So instead of the pool being backed by residential mortgages, it's backed by commercial properties. Some are CMO structures, some are MBS structures, but both of those MBS products providing amortizing cash flow versus static cash flow.
So a lot of government implicit or explicit guarantee.
Absolutely.
Low risk.
Yep.
From a credit quality perspective. So then we get into a little more esoteric's totally the wrong word, because there's nothing esoteric about these investments, right? It's just a little bit more credit risk in some of them. So CDs actually is really more like the previous page. Certificates of deposit, everybody knows what these are. You issue them to your community, right? So you're already participating in that, and you probably own some in your portfolio. So we don't need to spend too much time. Corporate bonds and municipal bonds, they start to introduce a little bit of credit risk. So now instead of basically lending money to the government, you're lending money to a corporation. And so it's very important when you get to credit risk that you understand the types of investments, right? One of the things I'm always very proud of, I pat the credit team on the back. They're probably listening now and hearing this, which would be great. They underwrite every single corporate bond and municipal bond that we recommend. And just in the same way that you're underwriting a loan to your community, right? Somebody comes in and you give them a loan, you want to know their financials. The same thing. It's no different, except we're working with a company instead of an individual. And by taking on that little extra risk, you're able to take on more yield. And these are incredibly old muni example yields here, but you can see there's tax implications too. If there's a BQ or tax exempt municipal bond, bank qualified, if you're a bank, then there's advantages. You can even go in and get a lower yield because there's tax advantages. And then there's also taxable municipal bonds as well. So we could dive super deep. We're not going to do it on this one, but here's a list of credit quality or credit related investments.
Yep.
Your favorite part, Alicia?
My favorite part.
Go into policy. So what are we looking at here? Lots of words. We're not going to read everything, but what are we talking about?
Good thing I wore my glasses today. So essentially the slide does have a lot of bullet points on them. There wasn't any way for us to minimize them. These are sections that are traditionally included in your investment policy. I.e., or I shouldn't say i.e., your investment policy should be reviewed by your board on an annual basis, meaning they should go through all of the different sections. They should read through the policy, make sure that they understand it, because they're also ultimately responsible for everything that's in there. But all of the bullet points on this page are things that are required by regulation to be in your investment policy. Our purpose and objective to simply state why we have an investment policy and what it allows our investment portfolio to do, down to what's the purpose of it? Who has the authority to approve investments? Where are we going to safekeep them? Where can we buy them from, and what can we buy? It's literally the who, what, where, why, when of our investment policy. It outlines all of the really, really big pieces. And then the next slide, if you want to slip it down or skip down,
very good. Yep.
Gets into the risks.
Yeah, so when we think about risk, there's a few that we need to think about, right? Interest rate risk is something everybody knows about right now because rates went from 0 to 1,000, basically, right? They
Yes.
went up 450 basis points, almost 500, and that's a lot of interest rate risk. So our policy needs to handle that. How do we handle interest rate risk? But how do we do it from how do we prevent it? How do we maintain, not just prevent it completely, but how do we understand it so that we're not overly, over our skis, so to speak, with interest rate risk? And you can see down the list here, lots of things: liquidity, concentration. There you go, SVB right there.
SVB.
Maybe we don't buy all into one asset class. That's probably a good thought. And especially, by the way, going back to full balance sheet management,
Yeah.
if you're an institution and let's say your niche is mortgages, you do 80% of your loans are mortgages. Okay, well, you probably don't want to be buying 80% mortgage-backed securities in your investment portfolio.
Absolutely.
And the reason is they're going to act the same way. And rates go down, everybody prepays, they're going to have a bunch of cash, and rates went down. So now you're going to hold on cash and be invested at a lower yield or lend it at a lower yield.
Yeah.
So all these things are in the policy, but they're also strategic conversations. And Alicia, I love this quote at the bottom here.
It's one of my favorites.
Yeah. Favorite president ever, right?
Yeah. So successful investing is about managing risk, not avoiding it. We know that every institution has their own unique risk profile, and corporate bonds or taxable municipal bonds are not going to be for everybody. They have risk to them, but that doesn't mean that we can simply avoid the risk in any portfolio. Just like ALM, it's about managing that risk and being comfortable with the risk that we're taking so that we can supplement our earnings.
Our industry gets paid to manage risk.
Yes, absolutely.
Right. All right, so a few more things. Policy needs to take a look at what happens if something falls out of policy. What do you do? Conflicts of interest, safekeeping, and how we classify things. So I think this is really here for anybody who wants to share this and go back and look at it. And by the way, good time to say, if you're working with McQueen, you're working with us, we're going to do this with you.
Yes.
Right? We have the technology, we have the templates. We're going to customize it for you based on your strategy. Don't feel overwhelmed at this point. How am I going to do it? We're going to hold your hand the whole way if we're working together.
Absolutely.
All right, let's get into some specifics on the trading. So what do we talk about when we're talking about trading?
So you can do trading a couple of different ways. You can work with an investment advisor like us here at McQueen, or you have the potential to work with a broker dealer. There are two different markets in which we all kind of play in. There's the primary market, so anything new issue, municipal bonds, agency bonds, callable bonds, corporate bonds, the list goes on and on. But it's the day that things come to market as new. Then there's also a secondary market. That primary market pricing is dictated by the market. So if you've got a municipal deal that's coming to market today, the yields and coupons on that deal are going to be set by where the treasury curve is that morning when the deal is priced. The secondary market, that pricing is then dictated by the dealer. So that deal priced on Tuesday, let's say, and there's some extra pieces floating around, somebody sold them and didn't want them, or they've already been resold to the market, which as credit unions and banks, we cannot do, just so you know. That pricing gets dictated by the dealer. So it's in part set by the market. Where has the market moved over the last couple of days? What is the bid-ask spread on that individual product? But the broker needs to make money. So the broker is going to put their pay into there. Sometimes it's a tick, sometimes it's 5. I've seen it be ridiculous, as high as 10 or 15. But you tend to pay up a little bit for things on the secondary market because there's more money to be had there. So that's the biggest difference between a broker dealer and an investment advisor. We aren't going to mark any bonds up for you. We have a very large broker dealer network that we work with. And we want to make sure that we're executing our bonds for you at the same price. Additionally, because we don't underwrite anything as an investment advisor, we aren't going to try to sell you the bond of the day. And anything that's purchased, which is this next step, is going to get delivered into your individual safekeeping account, and it will be delivery versus payment, as where if you buy something directly from a broker, it will end up potentially in your safekeeping account with that broker and not delivered into potentially your corporate credit union or your FHLB account.
So I moved ahead a little fast for you there, Alicia, but this is this is a great example of those brokers, right? We have an illustration of what happens if you're trying to buy something, right? It's actually regulation, is it not? You need to have multiple offers. 3 quotes.
3 quotes.
So when you're looking to buy something to the investment portfolio, you start with a strategy, come up with policy that meets the strategy, but then when it's time to execute, you don't want to just go buy it from the first person that you might have the best relationship with ever. They're awesome. They always send you the toaster. I don't know if
The
they do that.
bobblehead. They send you the
They send you
bobblehead.
the bobblehead. You don't want to just go to that person and take their word for it. You can see in this example, awesome example. Let's say we're buying a mortgage-backed security of $2 million. Well, broker number one might have a certain, I know these numbers look funky if you're not used to seeing it. It's basically 103 and a half essentially is what this is, $103.50. And you can see there are different prices here. So the total cost based on the offer that the broker's selling it at is there's going to be different costs. And you can see in this example, that's a $2,000 difference just because you found somebody who gave you a slightly better, bid or
Yep,
offer.
offer.
Yeah. So one of the things is, Alicia, you mentioned it's super important that you put brokers in competition with each other, and that's something that we
Absolutely.
take very seriously. And we don't always call the same three. You call a bunch of people and you get everybody bidding on something, and the ultimate result of that is you're going to have the best execution, and you spread that over many, many bonds and many, many years, and it's going to be tens of thousands, hundreds of thousands of dollars of difference.
Yep. Yeah. The $2,000, if you're only doing, let's say you do 5 trades in a month, each for $2 million. At the end of the day, if you don't get the best pricing in this example, for example, you spent an extra $11,000 to execute those 5 trades.
$100,000 more a year.
Yep. Works out to be an awful lot.
All right, as we're starting to land the plane now, we're going to get onto documentation, another riveting topic, but important topic.
It is just as important as your policy.
Exactly. You can tell where my heart's at. I like to, let's talk about bonds, but here we go. We're going to talk about documentation. So pre-purchase due diligence, actually, it is kind of fun because this is where the analysis goes in.
Yeah.
How do you decide how to buy a bond? So let's talk about this a little bit, Alicia. Why this security? What does that question mean?
Why the security? I never want a client to say to an examiner or regulator when they say to them, why did you buy this bond? Well, because McQueen told me to. I mean, it's a great answer. I'm glad that you put that much faith and trust in us. But I also want to make sure that every single bond that we recommend that a client approves, they have a full understanding of what that bond is, what it's made up of, what the risks are, what the yield is, the settlement date. I want them to have everything. So why this bond? So our email recommendations will always give all of the minute details that you need to have when executing a purchase, your dollar amount, your settlement date, your yield, a comparison to something else. But what is the bond actually? Is it callable? Does it have extension risk? Does it have credit risk? If it does have credit risk, do we give you the S&P and Moody's ratings? We're always going to give you that McQueen rating. That's going to come not only pre-purchase, but it's also going to come post-purchase on a quarterly or annual basis, depending on the type of bond that it is. And then any sort of Bloomberg screens that may or may not be necessary, dependent on the type of bond. If it's a treasury note, there really isn't anything that you need from Bloomberg. If we're showing you a CMO that has different tranches that each one of them waterfalls differently, we want to make sure that we're showing you how the bond is anticipated to pay. But what if it doesn't pay that way? What happens if it starts to extend and it pays slower than expected? Or what happens if it shortens up and it pays a lot faster than expected? We want to make sure you have all of that at your fingertips. So when you go through an exam, you can pull that file and say, here it is. I know exactly what it's going to look like. Here's why I recommended or approved this bond. I've even seen in the absence of trade tickets, going back when we did everything on paper, doing some separate bond review for clients where I've asked for a copy of a trade ticket. They'll send me the whole bond file, and on the email recommendation, there's notes. I liked this bond because, and it lists a couple of things. So it's really neat to see that they have all of those things documented and in their own individual file, which depending on which portion of the regulation you're reading, every bond is supposed to have its own file until it matures. And at that point, you can then get rid of it.
And by the way, if CMO waterfalls have you scared, we have a webinar for you. Investments 201. Don't worry about it. We'll talk about it, right?
Yep, absolutely.
Okay, great. And one of my favorite things that I hear is when talking to somebody and an examiner's, there or come in and they're asked a question, where's your credit report? Where's your due diligence? And then we hear our clients say, thank God for that email. It's right there. I pulled it up and it's the track record of all the analysis that fits the policy, that does what we say we're going to do. It's all there. And it really takes the stress off because we're doing what we need to do. And we're showing that we need to, we're showing what we need to show.
Yep.
So before we get into questions, let's just summarize what we're talking about. And one of the most important things, I think, is investment strategy. Alicia, you mentioned this when we were on the ladder slide.
Yeah.
Is that investment strategy will differ from one institution to the next.
Yes.
And it's not cookie cutter at all.
No.
But there are some principles that line up with almost everybody. We talked about them: safety, liquidity, and looking at yield. But it really differs from one institution to the next. So one of the things that we encourage everybody on the call to do: talk to your advisor, make sure that we are talking about goals. What are we looking for this year? Cash expectations, what type of growth expectations do we have? All those things. Let's open up the ALM report and get really nerdy with the balance sheet and make sure that our strategy makes sense for you. And we can leave those calls feeling like every rock was lifted up and we're really, really happy with our specific strategy.
Yep.
And then asset class diversification. Anything else to add on that?
No, other than, well, I guess, yes, actually, there is no one size fits all strategy. What works for one institution doesn't necessarily work for the next. Everybody's balance sheet is different. Everybody's loan makeup is different. So everybody's investment strategy they may be similar, but they will be different, not only from like I said, balance sheet makeup standpoint, but also from a risk parameter standpoint.
Right on. And then the investment policy should be, I like this one. So it should be specific enough. It should be specific. That's a hard thing to say. It should be specific enough to fall under all the regulations and requirements, but it needs to be flexible, right? We want the policy to serve us and not us to serve the policy. So sometimes when we're helping institutions rewrite their policy, maybe they've had the same one for 10 years, we'll go in there and make sure that it's not overly burdensome and complex, and you have to do this and then this and then that in the exact order, otherwise you're out of policy.
We've never seen one of those.
They're out there, and in fact, somebody on this call is probably saying, "Hey, man, we need to change our policy."
We've done this.
Yeah. So let's make it not overly simple, but as complex as it needs to be, and then no more complex than that, so that it can serve us and we can have it can really serve our institution and our strategy.
Yep. And then the last one there, keep detailed records pre and post purchase. Again, because McQueen told me to is never a great answer. We've gotten on calls in the past with examiners and regulators to try and explain things, but we want you guys to understand every single investment that we are recommending. And we want to make sure that their approval comes upon a full understanding of that. And if it doesn't, we're more than happy to sit down with you, your team, your ALCO committee, and go through any different asset classes as necessary. But making sure we're keeping all of those records, all of those credit reviews, and those emails to support all of the purchases that are approved and then investments subsequently put into the investment portfolio.
Nice. A nice word, by the way. Subsequently. Very good. And I'll just add one more thing because you made me think of it, and then we'll turn to questions. You mentioned us helping people with different, things, and we can do training, and we do training all the time. It's one of my favorite things. Hey, we just hired this new finance person or a new CFO, and they have experience, but we want to get them up to speed with our strategy. So please leverage us. We want to be a really good partner and teach anybody on your team. Let's jump on some calls. Let's bring the whole gang in, and we can even do a board education as well. So we really want to we take it seriously. We want to be your trusted financial partner, and we can do that with investment education as well. Anything else before we move on to questions, Alicia?
No, I don't think so. You summarized it very well.
All right, excellent. So that brings us to Charlie, your favorite slide ever.
So I love this, and some of the.
And you are on mute at least. Oh, I'm sorry.
No, my back. I'm back. I'm here. Okay.
No,
Thank
he's
you.
on.
You're there, Charlie.
And Zach, the verbose between the two of you has just been absolutely wonderful. I come from an English teacher as my mother, so the word choice has been phenomenal today. So really excited about it. I did have to start off with this. Here is the bobblehead, just in case you really wanted to know. I went out and grabbed it. So it was just great. And my hair looked a lot darker on the bobblehead, but there we go. So thank you guys. Great presentation. Great stuff in there. Really good information. And a couple questions have come in here. I'm going to go through them as we give you a couple now. One of the comments, the last question came in, and of course, go backwards. It's much easier. You mentioned detailed records need to be kept for both pre and post purchase. What about when selling investments? Do we need to do the same thing?
From a bid standpoint, yes. Your trade letter will have all of those on there. So when we go out to the market, we're not just going to we're required to get 3, but we're going to go out to more than 3 every time. We want to make sure we're getting a very broad view of the market, and we want to make sure that we're executing any sales at the best price to maximize a gain or minimize the loss, depending on what the scenario is. The 2 strongest bids next to the sale price or buy price will always be on that trade ticket. So it's very important to keep those sale records as well. But I do not believe, and Charlie, correct me if I'm wrong, if you need to keep your credit reviews unless you're selling for credit reasons after that.
Yeah, but it doesn't hurt to keep them. But yeah,
No.
I think your point. One of the things when people sell, they don't always think that they should go out and get multiple quotes like you get when buying things, and it's a lot of people don't sell very often, but it's extremely important. We see vast spread differences when selling securities, so really, really
Extremely important. And that's where that big difference between the broker dealer relationship and an investment advisor relationship comes in, because if you are only working with a broker dealer, you're only going to get one level. You're going to get the bid level from the broker dealer. So they have the ability to mark that bond up in order for them to make a little bit of money, because they won't make as much money on a sale of a bond as they will the purchase of a bond for your portfolio.
Yeah, great point there. Thank you. Another question that came in: we pledge mortgage-backed securities to the new bank term loan fund?
Mr. Whaley?
Yeah, that is a federal, it's considered a federal investment. So I believe anything that is related to the Fed, such as treasuries and mortgage-backed securities, can be pledged. Yep.
Yeah,
So we're not looking at CDs or corporate bonds. We're looking at the good old government stuff, and it makes sense because it's a Fed program.
Correct. Yep. Mortgage-backed securities, Fannie, Freddie, those types, not private label. So very cool. Thank you for that information. Speaking of other types of bonds, a question that came in here, a bit of a softball one for you guys. I'll throw it out here, but can credit unions buy municipal bonds?
Yes. Credit unions can buy municipal bonds. Most credit unions are going to buy taxable bonds. From a tax exempt standpoint, there's 3 different types of municipal bonds: bank qualified, which they cannot buy. They could buy. There's just no incentive to do so.
You don't want to buy, I think, the
Right.
term I'd use there.
Yeah. Tax exempt bonds and then taxable bonds. Credit unions can buy both tax exempt and taxable. The difference is because credit unions are tax exempt themselves, the yield on those tax exempt bonds tends to be significantly lower than a taxable bond. So it doesn't make sense. That's not to say that we haven't had requests for them or we haven't looked at them for a couple of different institutions. If the municipality in which they're located is issuing bonds, or the school district next to them is issuing bonds, sometimes we have a request for them for no other reason than community support. But they tend to be more taxable focused than tax exempt focused.
Cool. Thank you very much. Primarily taxable is what we should be buying.
Correct.
Yep.
Okay. Given the current interest rate environment, is there any particular strategy you're recommending for your clients right now?
Ooh, I'd love to take this one, Alicia. Can I?
Who's got cash?
Yeah, true. Well, there you go. Is this a trick question, Charlie? Who's got cash?
Some do. Not all, but some.
Yes,
No,
Mr. Willie, go for it.
Yeah, absolutely. No, it's funny because actually more and more we're seeing people tell us that their cash levels are leveling and they're looking to invest. So here's the real answer is it depends on you and your strategy, right? Your balance sheet. For some, it might make sense to do one thing, others a different thing, but that's kind of a cop-out answer. I want to give something more specific. So if we look at your balance sheet and it looks like you have appropriate, risk position to where if interest rates go up, your ALM report says you're going to be just fine. It's not a big deal. Well, we really have a bias right now that the market's telling us interest rates are probably going to be lower at some point in the near future. That might be 6 months from now, a year, theoretically it could be 2. The inversion of the yield curve is showing us that the market thinks the Fed is done hiking and their next reaction will be down. All that to say this: if we have a structured ladder where the ladder looks great, we've got those bars going like this, we like going out a little bit longer, extending duration. Even though there's an inversion of the yield curve, you're going to get paid a little bit less to do that. You're going to be so happy you did. If interest rates fall, you're going to be locked into those rates. And one of the key features is we want to make sure we don't buy optionality or be very limited with optionality. We don't hate it, but maybe we do sometimes. If rates fall right now and that bond gets taken away from you, that's what optionality means. you're going to have cash in your hand and you're going to be reinvesting it at lower rates, and that's going to hurt earnings.
Yep.
Anything to add to that, Alicia?
No, that's fantastic. Like you said, minimal optionality, prefer none at this point. Sometimes we can't get away from it depending on specifically what we're looking at. Yeah, minimal optionality, no negative convexity, and going out a little bit longer if our interest rate risk position allows us to do so.
And I'll add one more thing, Charlie, actually, if you don't
Please.
mind.
Yeah, please, Ed.
Often we talk to people and they say, you know what, we want to optimize yield, but it's just not the time. We don't have the cash. It's like, okay, great. It's actually now's the time to talk about this from a policy perspective, right? If you've always done CDs, if you've never done banknotes or corporate bonds or munis, now's the time. It really is. Let's get it in the policy. Let's get the education going. Get a board meeting together. It doesn't, whatever we need to do, because one day cash will come back and it might be sooner than you think. So if we're well positioned to go forward with strategy and policy, it's going to be so much easier to do that. And there's a lot of value out there above the risk-free treasury right now.
Yep.
Wonderful. I appreciate that, Zach. One of the things that we've talked quite a bit about over the last couple of years, last year and a half, we talked about getting more borrowing capacity in a lot of our ALM presentations to be prepared for this different environment. We had so much cash that at that point, that's when you look for borrowing lines. And yields are high right now. They're high. Do they go higher? Probably not. Do they go lower? Probably, but who knows? There's some people calling for much higher interest rates right now. A lot of people think the Fed needs to raise rates quite a bit more to stomp out inflation. We'll see where we go, but we are at a higher spot now, so it's a great time to think about some different asset classes, non-optionality based activities. So really, really good points. So with that, that is the last of our questions. And I did get an email earlier today that said ending early is always good. Ending late is terrible. So with a few extra minutes here, we'll wrap stuff up. So Zach, I appreciate your expertise and information and sharing today. Alicia, I also appreciate your expertise and information and sharing today. You guys provide some wonderful education to a number of clients and to a number of our coworkers here at the company. So I really appreciate all that the two of you do.
Thank you, Charlie. Appreciate your leadership, and thank you everyone who joined us today. And this will be on YouTube, so pass it on if your team wasn't able to join.
Yep. On the next slide here, we should have our upcoming webinar, just to let everyone know. ALM 201, this is part of our 101 and 201 series. We did ALM 101 about a month ago. Obviously, we're doing investments 101 now. We'll do ALM 201 on April 26th from 2 to 3 p.m. And then actually after that, when we get into May, we'll be doing our investment 201 that Zach and Alicia referred to earlier. So thank you all very much for spending some time with us. Again, these will be available by reaching out to your advisor. Your advisor can send you a link to this, provide the slides. Also, you can check out our YouTube channel. Thank you very much. Have a wonderful day, everyone.
Thank you, everybody.
Bye-bye.
Bye-bye now.